Welcome to the Pirls Stock Market Commentary video, your weekly window on stock market technical conditions, featuring the proprietary bull-bear point and figure market breadth summary chart for June 25th, 2017. Market breadth. With this past week's market advance, our bull-bear point and figure ratio at 1.11 fell from 1.22 last week, declining slightly within bullish territory. The total count of securities in bullish or bearish patterns increased fractionally to 3,014. The count of bearish stocks increased 6%, while the count of stocks in bullish patterns decreased 4%. The Pirls P&F Market Breadth Summary Chart shows us a market now 5 weeks in bullish territory. Paid subscribers have access to the Open Office Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. To subscribe free of charge to the weekly Pirls Stock Market Commentary email, simply enter your email address in the space provided and click Subscribe. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, fell 29 points for the third decline in 9 weeks. At a positive 132.57 points, it continues below all 7 tops above plus 100, and it continues above all 5 bottoms below minus 100 in the last 3 years. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in accumulation mode, with average daily volume higher than the prior week. In the last 2 weeks, the Nasdaq had 1 accumulation day and 2 distribution days. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq ended in distribution mode on higher average daily volume. Momentum, now at 42.69, up from minus 77.17 last week. At Wednesday, 6/21 close, the CCI 20 daily signaled a zero-line reject long entry and continued increasing through the remainder of the week. We will follow the results of this trade simulation in next week's commentary. In Woody's CCI trading system, 6 consecutive bars above or below 0 are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 60 weeks ago, while the daily CCI 20 began a Woody's uptrend 31 weeks ago. The CCI 20 weekly has risen to a positive 112.05 from a positive 93.60 last week. We await the return of the CCI 20 weekly to the plus or minus 50 range for another potential simulated CCI 20 weekly trade. Industry rotation the last 2 weeks. All of the top 5 industries are positive, and all of the bottom 5 are negative. Summary: tech on top, oil, oil services, and banks on the bottom. Bullish, CompTech, disk drives, and S&P retail have left the bottom 5. Computer hardware, CompTech, disk drives, and networkers have entered the top 5. Bearish, gold and silver has left the bottom 5. Brokers and KBW Bank have left the top 5. KBW Bank, oil services, and oil have entered the bottom 5. Focus this week from www.zerohedge.com. It'll be an avalanche. Hedge fund CIO sets the day when the next crash begins, by Tyler Durden. The following are some key points and charts. On Sunday, a prominent hedge fund manager, One River Asset Management's CIO, Eric Peters, broke with that tradition and dared to pin a tail on the donkey of when the next market crash, one which he agrees with us will be driven by a collapse in the global credit impulse, will take place. His prediction? Valentine's Day, 2018. Here is what Peters believes will happen over the next 8 months, a period which will begin with an increasingly tighter Fed and conclude with a market avalanche. The Fed hikes rates to lean against inflation, said the CIO, and they'll reduce the balance sheet to dampen growing financial instability, he continued. They'll signal less about rates and focus on balance sheet reduction in September. Inflation is softening as the gap between the real economy and financial asset prices is widening. If they break the economy with rate hikes, everyone will blame the Fed. They can't afford that political risk. But no one understands the balance sheet, so if something breaks because they reduce it, they'll get a free pass. The Fed has convinced itself that forward guidance was far more powerful than QE, continued the same CIO. This allows them to argue that reversing QE without reversing forward guidance should be uneventful, like watching paint dry. Balance sheet reduction will start slowly and proceed for a few months without a noticeable impact, he said. The Fed will feel validated, like they've been right all along. But when the global credit impulse reverses, it'll be a cascade, an avalanche, and I pin the tail on that donkey to be Valentine's Day, 2018. Of course, the global credit impulse is something that we have been exclusively warning about for the past 4 months, but apparently it wasn't until Citi's report last week which explained it's all that matters. That suddenly everyone admits to paying attention. We'll take it. Thank you for watching this week's Sand to Pearls Stock Market Commentary video featuring the proprietary Bull Bear Point and Figure Market Breadth Summary Chart compiled by Donald Pearl, www.s2pmarketsignal.com. Hoping that you are enjoying a peaceful and pleasant weekend, that you are looking forward to a prosperous and productive week coming up, and wishing you true success.